okay, that rally up or that impulsive price swing, we only require price to start coming down off of that, and it takes at least 4 candles. No matter what time frame you're on, you need 4 candles, okay, from when the market makes a low and starts rallying up. What you're going to look for is once you see a high form, let me zoom in. Once you see a high form, you need 4 candles. Why 4 candles? You need to have 1 candle to the left, 1 candle in the center, the most highest one, then a lower candle to the right. That's a swing high, and then you got to see price go lower. When that happens, you start waiting for price to retrace back to equilibrium. Now, what is equilibrium? Equilibrium is a midway point of a price move. Okay, so we're measuring the high from this low. You take your fib, you draw it up to the low, and you drop it. Equilibrium is over here. Let me scrunch this up a little bit more. Okay, so we have this price leg up. So impulsive price swing goes higher. As soon as we get 3 candles, then and only then will we start watching for price to come down to the equilibrium price point, and that is basically the Fibonacci level 50%. Okay, we're looking for price to come down to that level, and as soon as it comes back to that level and we're on a daily chart, we go down into a lower time frame and we hunt buying opportunities. Now, I'm not teaching you buying entry signals, okay? I'm giving you context of how to discern when the market goes to discount and when it's at a premium. And we're not trading at premiums, okay? Well, I'll teach you how to use premiums the first video of next week, okay? So we're only focusing primarily on equilibrium versus discount. We have a price swing that moves from a low aggressively up. We don't do anything until we start seeing a down move, and it has to happen after 3 candles, basically making a swing high. Now, a swing high looks like this. Okay, you can see it has a high and a candle to the left that's lower and a candle to the right that's lower. That's a swing high. And once that swing high forms, we're waiting for the 4th candle, okay, to start coming lower. In other words, we're looking for 4 candles to start turning around. When that happens, okay, that gives you, now you're allowed to start looking for the market to come down into equilibrium. That means the 50% level. Okay, once you're on a 50% level and you're in a higher time frame, and we start everything at a daily chart. At the daily chart, we know now that between the low here and the high here, the market now has gone back to equilibrium. So it's at fair value or at fair market value. If you get something at fair market value, obviously you're not paying a premium, but you're not really getting a discount either. But it's still a neutral to bullish condition. That means you're not buying at an inflated price. So this time period right here, the market is offering an opportunity to be long. I'm not going down to lower time frames today. I'm not going to teach you that today. Only thing I'm giving you right now is developing context around the daily institutional price levels that are arrived at on the daily chart. And all you're looking for is impulsive price swings first, letting price settle back down into equilibrium, and then we discern what we're going to do when we get to that level. As you can see, without going into lower time frames, the price does rally again. Where does it rally back up to? Its old institutional order flow reference point, which is an old high back here. So it goes right above that previous high. See that? Now the market trades off again and goes lower. So we have now a new range. We have to now put the Fibonacci on this high, keeping it off this same low. Now, why did I do that? Because this price low has not been violated. It only retraced down to here. It rallied up again. Then we wait for 3 candles. The high candle to the left, there's a lower one. To the right, there's a lower one. This is probably a Sunday, and even still, this is one here. Either way, you don't want to count Sundays, by the way. MT4 on Forex LTD does give you the Sunday candle, so you got to factor that out. Don't count Sunday's candle because it's a non-event. So that's probably going to end up becoming this candle here. Once you get the down candle here that the market has in fact turned, it's starting to go lower. Notice what's happening here. We're not rushing. We don't need to catch the high. Okay, it gives us all kinds of time to wait and plan and build an idea about what it is specifically we're going to do when price gets to equilibrium. Price drops down a little bit more, then it goes up. What do we do the whole time this is happening? Nothing. We're not doing anything. This is a higher time frame principle. Most of you are all begging for a higher time frame principle to trade with. This is the beginning building blocks to that. Okay, market trades lower, lower. What do we do here? Nothing. We're not doing anything here yet. Okay, nothing. Trade lower, 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 lower. All of a sudden, boom, it hits equilibrium over here. Now we can start studying price. We want to study price. On the lower time frames, we'll look for entries, but I'm not teaching you entry signals here. I'm giving you context. As soon as we get to equilibrium, we are now at fair market value, so the market is permitted to be bought. Okay, at the banking level, they will be able to buy at these levels because they're not at a premium-based market. The levels that are trading at this level here are at fair market value. Now, banks are just like anyone else. If you go to the grocery store and you see steaks for $10, I don't even know what they cost because my wife does all the shopping. If a steak costs $10 at the market and it drops down to $8.50 a steak, that's probably a discount. And it may not be that price, I don't know, but for the sake of analogy,